July 1944. World War II isn't even over, and yet 44 nations meet in a quiet hotel to decide one thing: who controls money after the war. That decision still controls your paycheck, your rent, and your savings today. Here's the uncomfortable truth that makes this worth your time. So let me ask you a blunt question, right now before the history lesson turns into your life. When prices climb, when debt feels permanent, when saving feels pointless, are you sure you're the one failing, or are you living inside a design? Because once you see what happened in that hotel, you stop blaming yourself for outcomes that were baked into the architecture. Let's walk into the room where the architecture was approved. Bretton Woods sounds like a place you'd go to breathe clean air and forget the world. That's exactly why it worked. While soldiers were dying across Europe and the Pacific, 730 delegates spent about 3 weeks inside the Mount Washington Hotel arguing over the financial rules of the post-war planet. The public mission was stability no more. Currency chaos like the 1930s. No more competitive devaluations, no more breakdowns that spill into conflict. But stability is a word you use when you don't want to say power. Inside that hotel, it wasn't calm, academic debate. It was hard bargaining, because everyone understood that the post-war order would decide who rebuilds fast and who rebuilds begging. Some countries arrived desperate for stability because their currencies had been shattered. Some arrived terrified of another Great Depression, and some arrived with a quiet objective: make sure the next system can't be used against them the way the last one was. But one fact dominated the room. The United States could offer what no one else could offer at scale: industrial output and settlement assets. If you wanted American machines, American food, American fuel, you were going to need American terms. That's why the conference wasn't balanced, even if the table looked balanced. Keynes had ideas. White had leverage, and leverage wins, even when the idea is elegant. When you hear 44 nations agreed, don't picture 44 equals signing a shared dream. Picture a war-torn world choosing the only functioning exit door. Because the real question was simple: who gets to sit at the center of the system? If your currency becomes the center, you don't just trade. You set the price of trade. You don't just lend. You decide who gets credit. You don't just help. You attach conditions to help. Britain arrived like an old king who still wore the crown, but the crown didn't fit anymore. John Maynard Keynes, brilliant, famous, exhausted, wanted a neutral global unit that didn't belong to any single nation, a way to stop the world from orbiting one capital. Keynes even had a name for his neutral unit: the Bancor, a shared accounting currency meant to reduce imbalances and keep any single nation from turning its printing press into global power. In other words, Keynes wanted an engine with a governor. White wanted an engine with an American steering wheel. And when you're the creditor, the factory, and the gold holder, you don't compromise down to neutrality. You export your system. That's why this moment matters. The world didn't choose the dollar because it was morally superior. It accepted the dollar because the alternative was rebuilding without fuel. America heard Keynes's neutrality and thought, neutral for you, powerless for us. The U.S. delegation, led by Treasury economist Harry Dexter White, pushed a different idea. Don't create a referee, become the referee. And the leverage was obvious before the first argument started. America's export machine was humming, and the U.S. held the war's biggest bargaining chip: gold reserves concentrated in one place, under one flag. So the deal that came out of Bretton Woods was simple enough for headlines and sharp enough to run the world. Every major currency would be pegged to the U.S. dollar at fixed exchange rates. The U.S. dollar would be pegged to gold at $35 per ounce. Foreign governments and central banks could redeem dollars for gold on demand. On paper, it looked fair. In practice, it created a one-way advantage, because discipline was not shared equally. If France, Italy, or Japan wanted to keep their peg, they had to defend it with real pain. Tighter budgets, higher rates, import cuts, wage pressure. If reserves ran low, they had to scramble. But the United States just defend the system. The United States supplied the system, and that's the first inversion you need to remember. It wasn't that the dollar served the world. The world was trained to serve the dollar. Here's why this matters. If you don't understand how this system was designed, you'll spend your life blaming yourself for outcomes that were engineered decades ago. Now let's look at what the wiring actually did, and this wasn't a hidden, secret meeting. It was open, official, documented. The secret wasn't secrecy. The secret was that most people never learn how the wiring works, so they mistake design for destiny. Now let's look at what the wiring actually did. Quick note before we go further. If you like financial history that explains systems, not headlines, subscribe now. This channel is a documentary, not a debate show. A fixed-rate system sounds boring until you realize what it forces every country to do. Here's a practical way to see it. Imagine you're running a country in 1950. Your factories need imported equipment. Your people need fuel. Your hospitals need medicine. You can't pay for those imports with hope. You need hard settlement, so you need dollars. How do you get dollars? You export to the U.S., you borrow dollars from banks, or you go to the IMF when the balance of payments breaks. And the moment you're hunting dollars, your policy space shrinks. You start designing your economy around what earns dollars, not what serves your citizens, because if the peg fails, your currency collapses, imports become unaffordable, and politics turns into panic. That's why fixed exchange rates were never just finance. They were discipline by design, not discipline for everyone. Discipline for the nations that didn't own the anchor. So the trap wasn't simply that the dollar was central. The trap was that the dollar became the emergency exit, the refill station, and the scoreboard at the same time. When the same object is the fuel, the gate, and the judge, you don't have a market, you have a hierarchy. If your currency is pegged, you're promising. My money will trade for dollars at this rate no matter what. But markets don't care about promises, they care about reserves. So when investors, importers, or ordinary citizens start converting your currency into dollars, your central bank burns through dollar reserves to defend the peg. When reserves shrink, everyone smells weakness. Then pressure accelerates, then the peg breaks, then your currency falls in a way that looks sudden, even though it was building quietly. That means every non-reserve country lives with a permanent constraint. You can't just print when you're in trouble. You can't just spend when politics demand it. You can't just run endless deficits without eventually paying for them in credibility. If you want to stay inside the club, you need access to the club's oxygen. That's why the IMF mattered. Bretton Woods created the IMF and the World Bank as pillars of the new order, with the stated aim of stabilizing payments and funding reconstruction and development. And those pillars were anchored in Washington, D.C., with the U.S. as the largest shareholder in practice. So money became leverage a country could keep its peg if it had dollars. A country could get dollars if it could export or borrow, and borrowing came with a gatekeeper. This is why people say the system feels rigged, not because every loan was a conspiracy, because the structure ensured one thing. The center always had options, and the edges always had consequences. Now here's the real trick inside the phrase "as good as gold." It let the dollar play two roles at once. Global money is a different kind of power. If you're an ordinary country inside the system, you can't print your way out of trouble. If you try, reserves drain and credibility breaks. But if you are the country that prints the reserve currency, the world absorbs your paper because it needs it. So flip the sentence. Because it's the hidden motor. The world didn't use dollars because America was trustworthy. America stayed trustworthy because the world was forced to use dollars. And the longer that habit ran, the deeper the dependence got. Military power wins battles. Monetary power decides what winning costs. That's why Bretton Woods wasn't just economics. It was a blueprint for influence without conquest, control without invasion, pressure without troops, compliance without occupation. And every blueprint has a flaw. Now we hit the part nobody wanted to talk about in 1944. If the dollar is the reserve currency, the world needs more and more dollars as trade grows. But where do those dollars come from? They have to leave the United States. That usually happens through deficits. The U.S. imports more than it exports, so dollars flow overseas. Economists later described the tension clearly, the Triffin dilemma. The reserve currency country must supply the world with its currency, but supplying it can eventually undermine confidence in that currency's value. So Bretton Woods contained a built-in contradiction. To keep the system alive, America had to push dollars out, but the more dollars America pushed out, the more the world could ask for gold. At first, the math worked. Later, it didn't, and there's another layer most people miss. Those dollars didn't just sit in vaults. They circulated through banks. They became loans. They became deposits. They became an ecosystem of dollar claims outside the United States itself. Every credit system stacks claims, so the promise, redeem dollars for gold, wasn't only about physical bills, it was about the entire architecture of claims that relied on the story that the dollar was ultimately solid. By the 1960s, foreign governments started to look at U.S. spending and start counting. They didn't need a conspiracy to notice the math. They only needed to compare. How many dollars are out there? How much gold is really backing them? When confidence cracks, the system doesn't collapse like a building. It collapses like a bank run. And you can see the psychology of the moment in one simple question governments ask themselves in the late 1960s. If we wait, will there still be gold? That's why convertibility systems are fragile. They are stable only as long as nobody tests them. The moment people test them, stability turns into a race. And after 1971, the race didn't stop. It just changed targets. Instead of racing to convert paper into gold, the world raced to manage currency risk, inflation risk, and credit risk because now the anchor was gone, and the only thing holding the system together was habit. This is why the post-1971 era feels different. Money becomes more elastic, credit becomes more central, and volatility becomes normal. In the gold era, printing was limited by metal. In the fiat era, printing is limited by politics, and politics is rarely patient because the agreement said you can redeem dollars for gold. So if you think the gold is limited, the rational move is redeem first. France became the symbol of that doubt. The IMF's research notes the established view that France began deliberately converting dollar holdings into gold in 1965. And once that starts, everyone watches because nobody wants to be the last country holding paper while others take metal. So the U.S. faced a real choice, one that gets described politely, but it was brutal. Option A, stop spending, tighten policy, accept, slow down, protect gold. Option B, break the convertibility promise, keep the machine running, and bet that the world can't leave. On August 15, 1971, President Richard Nixon chose option B. He suspended the dollar's convertibility into gold. The gold window was closed, and Bretton Woods didn't fade, it snapped. Here's the inversion you should never forget. Bretton Woods didn't collapse because the world stopped using dollars. The world kept using dollars because leaving was expensive. By 1971, the system was already built around dollars, reserves, contracts, loans, trade habits, so the world stayed. But the nature of money changed overnight. Before, a claim on gold. After, a claim on a promise, and promises are easier to expand than gold. Before we finish, if you want more videos like this, real history, real mechanics, no fairy tales hit like so the algorithm doesn't bury it. Most people will never be taught this in school. That's why we teach it here. The gold promise was the lock. The habit of using dollars was the cage. When the lock broke, the cage stayed, which leads to the era you actually live in. Now, this is where the story stops being a documentary and starts being your life. When a currency is tied to a hard limit like gold, printing has consequences fast. When the tie is cut, printing becomes politics. It doesn't mean every politician is evil. It means incentives take over. If growth slows, you stimulate. If markets panic, you inject. If banks wobble, you backstop. If voters are angry, you spend, and over long periods, the cost shows up where people feel it most. Purchasing power, CPI measures are not perfect, but they show direction. The Minneapolis Fed's inflation calculator indicates that prices today are several times higher than in 1971, meaning a $1971 buys only a fraction of what it buys now. Now, flip it into plain language. If your money loses value quietly each year, you have to run just to stay in place. That's why saving can feel like swimming upstream. That's why wages can rise and life can still tighten. That's why more digits doesn't always mean more life. If you've ever wondered why modern life feels like it's built on permanent financing, this is one reason. Your mortgage is a bet on future income. Your retirement account is a bet on asset markets. Your insurance premiums are a bet on future costs. Even your phone contract is a microdebt with a monthly payment. You don't just buy things anymore. You subscribe to them, you finance them, you carry them, and when the system is built around expanding claims, you don't just need money. You need money that outruns price growth, housing more credit, more leverage, more paper promises. Ordinary people become the shock absorber because when something breaks, you don't get a new rule book. You get higher prices, tighter conditions, and a lecture about being responsible. So ask yourself, if the rules were written to stabilize nations and banks, why do individuals always pay the instability bill? That's not a moral question. It's a design question. And you feel it in 4 places. Savings, you save, but the target keeps moving. Homes stop being only places to live and start behaving like financial assets. When credit is abundant, housing absorbs it like a sponge. Wages do not scale at the same speed, so the ladder pulls up. Debt stops being a temporary tool and becomes a permanent environment. When the system runs on credit expansion, everyone is pushed to borrow just to keep position. Work becomes more intense, not because humans got weaker, but because the monetary measuring stick keeps shifting. And there's a sentence that explains why the game feels like it moves away from ordinary people. Credit reaches markets before it reaches families. So pause and ask yourself, if the measuring stick gets shorter, do you suddenly become worse at saving, or are you being measured with a tool that keeps changing? That's why people look around and say, my grandparents built a life on one income. Why can't I? Sometimes that's culture, sometimes it's technology, sometimes it's policy, but underneath all of it is the same foundation: what money can buy and how fast that ability changes. And this is where the Bretton Woods story becomes a warning, because systems don't last forever. Bretton Woods looked permanent in 1944. It died in 1971. And what replaced it, floating fiat with global dollar dependence, has lasted longer than many expected. But it carries its own contradictions: debts that grow faster than production, political pressure to expand money, and global rivals that would love to reduce their exposure to the dollar system. So here's my question for you, because this is the moment the video becomes interactive. If the entire world runs on one currency, what happens when the world starts building side roads? Not overnight, not with a dramatic collapse announcement, but slowly. One bilateral deal here, one alternative rail line there, one reserve portfolio adjusted by a few points. That's how empires weaken, not in one headline, but in 1,000 quiet reallocations. You don't need to predict the exact date of a reset to protect yourself from the logic of the system. You just need to understand what the logic is and what it does to people who never learn it. So here are the rules. In one last set of reversals, you were taught money is a tool, but money is a gate. You were taught inflation is prices, but inflation is time. You were taught the system is neutral, but the system has a center, and if you don't know where the center is, you'll spend your whole life paying rent to it. If this clicked, do 2 things. First, comment 1 word. Breton, I want to see how many of you are connecting the dots. Second, subscribe, not for motivation, for a map. In the next episode, we connect Bretton Woods to the modern cracks debt cycles, reserve diversification, and the slow shift from one global center to a more fragmented map. One more reminder, you don't have to agree with every interpretation to benefit from the map. Just knowing how the system was built makes you harder to manipulate inside it. History has the answers. I'll show you where to look.